This is a demonstration of exercise 24-4B, ratio computation and analysis, liquidity. As loan analyst for Second Bank, you have been presented the following information, and the problem gives us balance sheet information for Era Company and McCoy Company. It also gives us their annual sales and the rate of gross profit on sales. Each of these companies has requested a loan of $200,000 for 6 months with no collateral offered. Inasmuch as your bank has reached its quota for loans of this type, only one of these requests is to be granted. In the instructions it states that which of these two companies, as judged by the information given above, would you recommend as the better risk and why? And assume that the ending account balances are representative of the entire year. So we can only grant one of these companies, either Era or McCoy, the $200,000 6-month loan. So we're going to do an analysis of their financial statement information in order to be able to determine which of these two companies would represent the better risk for the loan. The first thing we would look at is what is the composition of these companies' current assets. So to do that, we would use common size or vertical analysis. So for each of these companies, I have taken their cash, receivables, and inventory and divided those by their total current assets. So in these two columns, we have the percentages for each of these three current assets divided by the total. And this type of analysis just allows us to compare companies that have different amounts and use a percentage basis to look at which one might be more liquid or have a better ability to pay back the loan. So looking just at this information, we see that Era Company has a higher percentage of their current assets in cash. So we know cash is the most liquid, the most easily available to pay back loans, whereas we have to collect receivables and sell inventory and then sometimes even collect the receivables on that. So we're interested in knowing that. The next thing we would want to look at is what is the ability of these two companies to pay back the liabilities that they currently already have. So in both of these cases, we would look at first the most stringent comparison would be their current cash divided by their current liabilities. So we see in this case that again Era has the better cash ratio because they have the 91% of their current liabilities currently in cash. So they're in a pretty good position right now to pay back the liabilities that they already have, whereas when we look at McCoy, we see that McCoy is not in as good of a position because they only have 37% of the cash to pay back the liabilities that they already have, and we're talking about adding an additional $200,000 to that. The next test we would look at is the quick or the acid test. So we would add to the cash in the numerator the receivables that the two companies have. When we do that, we see again that Era is still in a better position to pay back their current liabilities that they have at 1.36, and then McCoy that is still at 0.98. So even with the collection of their receivables, which would hopefully be in a fairly short amount of time, which we'll look at in just a minute, we would see that Era is still in the better position. And then the last ratio, which is the most liberal, is to compare all of the current assets. So now we would add in inventory in the numerator divided by the total current liabilities. And in this case, we see that Era again is in a better position to pay back the liabilities because they have 3.46 divided compared to McCoy only having 1.95. Of course, one of the things that you have to be concerned about is how quickly these companies are able to collect those receivables, if you're going to allow your comparison to include those, and then also how quickly they can sell their inventory, because if they can't sell the inventory quickly enough within that 6-month period, then that's going to impact on their ability to be able to pay back what they owe now, as well as the additional $200,000. So we would compute the accounts receivable turnover by taking their sales, annual sales, and dividing it by their receivables. The problem said that their ending account balances were representative of the entire year. Normally we would take beginning receivables and ending receivables and divide it by 2 to get an average. But if the 108,000 and 241,000 are representative for the whole year, then it's fine to just use that ending balance. We see in this case that ERA is collecting their receivables quite a bit quicker than McCoy is, of course, at 12 times a year compared to not quite 10. So that means they're collecting their receivables within about 30 days, once a month, ERA, and a little less than that for McCoy. The last ratio that we would compute would be inventory turnover, so that we could see how quickly they're able to sell their inventory that they have, their inventory balances. And to calculate inventory turnover, we divide cost of goods sold by inventory. We don't have the cost of goods sold given, but we can compute that because we were given their gross profit ratios, and we know cost of goods sold is complementary to the gross profit ratio, so we can determine the cost of goods sold by taking the sales times 1 minus the gross profit ratio. So we have the cost of goods sold for each of the companies, and we divide that normally again by average inventory beginning and ending divided by 2. But if the balances for inventory at the end of the year are representative, we can just use that one amount. And we see that in this situation that McCoy does have quite a higher inventory turnover ratio, which indicates that they are selling their inventory on average much quicker than ERA Company. So when we're making the decision between the two companies, out of those 5 ratios, ERA had the best ratios for 4 of the 5 that we tested. So they had the higher cash, quick, and current ratios and accounts receivable turnover. The only one that McCoy had higher was inventory turnover. So we could say that in all the ratios, ERA was ahead of McCoy except for that one ratio, and we would probably need a little bit more information on what they sell, because some inventory you would expect to turn over much quicker than other types. But since this is a short-term loan of only 6 months, I would grant it to ERA because they have the best prospects based on the information we have for paying it back in the short term. And that is the conclusion of the demonstration for exercise 24-4B.